Hi everyone, welcome back to Risk Biscuits. I'm Michael, your host. Thanks again for tuning into the show. As always, please like and subscribe, share, all that sort of good stuff. All of your support helps the channel and supports it going forward. Today I've got a special guest. I'm excited for this one. BisphamGreen, or better known as BisphamGreen, but to people that know him well, Angus. G'day, mate. How are you?
I'm good, thank you very much. Good evening from England, where it is a cold morning.
Yeah, and good morning to you. Look, before we get into things, I'll just share something up on the screen just to sort of cover off on a couple of bases and make sure everyone's on the same page. Look, obviously, this conversation's really purposes, all care, no responsibility. We're not really in the business of providing financial advice to you. We're just having a general chat if you're looking for financial advice for it. All right. So let's get into it. So I might sort of just kick off with, I guess, a little bit of a background about yourself and what I know about you. Obviously, we've sort of interacted on Twitter over the years and that sort of thing. So you're obviously come from an institutional background, but I believe trading mostly for yourself these days, or maybe
Yep.
maybe a bit of both, that sort of thing. But a sort of a bit of a specialist in terms of emerging markets and also bonds. Is that kind of a fair assessment of your background?
Sounds about right. Yeah, I mean, I never had any dreams of working in markets or anything like that. My background is as a geologist, bizarrely enough. Did a degree in geology, did the usual thing, applying to oil companies as you do, and I got a place, which was quite impressive because at that time this was 1998, the oil price was $10 a barrel. But I decided I wanted to do a PhD, so I did a PhD in geophysics. Figured out that I was just a young guy. I was 21, and I could, I had time to do something like this, even if it went nowhere, and I didn't need to worry about that. So I did that. That was fun. I've got to say, it was kind of a bit of a self-discovery time where I effectively worked out what my work ethos was like and what it took to kind of to get things done. And after that, I realized I never wanted to stay in academia. I mean, it is, I have friends who are. It's fun. I mean, people do stuff that they love, but at the end of the day, you've got to go from funding round to funding round, and there's never a lot of money. And it seems that some people make it and they're great and they are the superstars. A lot of people don't. A lot of people are just basically hand to mouth, going around looking for the next 6 months pot of money to live on. So I figured I'd do something different. It was the time of the dot-com bubble. But none of that stuff really appealed to me. I did apply to a couple of consultancy companies. I don't think they exist anymore because of all that kind of stuff. But I had a friend who worked with the same PhD supervisor as me, and he got a job in fund management in Edinburgh. And it sounded interesting, and I just thought, well, let's give it a go. So I applied to a couple of companies, didn't get anywhere with some guys. But I got a job in a at a kind of an old name kind of company in London, and that's where it all began. And they told me I'd be working in fixed interest, and I had no idea what fixed interest was. I just thought it was some special type of stock or equity or whatever you wanted to call it. And when I arrived, I kind of was shuffled into this, into the kind of the nether part of the trading floor, and sat down with some guys who traded European government bonds.
Okay.
That's where it all began.
Yeah, cool. So you sort of walk in, all of a sudden you realize that you're going to be trading bonds. So what was, obviously bonds are quite different to equity. So what was the kind of learning process around all of that and getting your head around what you're actually going to do?
Well, I had no idea what a bond was, so that was a tough thing to begin with. I couldn't. I remember initially wondering why on earth was there a thing called the yield, and why wasn't that the coupon? It's just, I mean, all sorts of things that now just seem extraordinary. But you just pick them up, and I think that, the main thing about this is that, you don't need to do a degree in something financial. You learn what you need to learn on the job, and, if you're a bit smart, you can kind of work it out. So yeah, so I was putting that kind of stuff. And this was a time, of course, when European government bonds were pretty dull. It wasn't long after everyone had gone into the euro. Spreads were nothing. I mean, basically, they'd be like, well, hey, Ireland is trading inside bunds, and swap from Austria 07s into Netherlands 08s and get a pickup of 2 basis points or something like that. I mean, this is really, not a. It was the definition of a pretty boring asset class, but that was kind of probably what I needed in terms of just getting the basics. And the people I worked with were good guys, and they took the time to, educate me in all this kind of stuff. And that's where it all started. I went. The emerging markets department was next door. The woman who was head of emerging markets was also head of fixed income, and she obviously decided that she wanted me on her team, so she just poached me after about 18 months, and that was how I started in emerging markets. There was no design, no nothing. It just okay. That was just where I was put.
Yeah, cool. All right, so you all of a sudden you've gone from a sort of a sleepy European desk to emerging markets, which tend to be a little bit more exciting and at least variable and that sort of thing. So what was that like? And I guess getting your head around all the different markets and different economies and that sort of thing.
Yeah, well, at the time, emerging markets was basically a dollar asset class. So, I mean, people did do emerging market equities. In the firm I worked for, there were people doing emerging market equities, but we didn't sit anywhere near them. I only got to know a couple of them because they were on the graduate program. So it was basically just 4 PMs, and they variably talked to each other and didn't talk to each other, and had their own clients that they jealously guarded. And they all had their own styles. Some of it was extremely was eccentric, I would say. And there was an index, and things were vaguely close to the index, and they just, well, I mean, a lot of my memory is that a lot of this stuff was just punting up and down, taking a liquid bond, Brazil C bond, as it was called then, which was something which came out of the Brady bond restructurings in the 90s. And that was something that was possibly the most liquid thing in emerging markets. And I just remember that thing being punted up and down. And this was around the time when Brazil was going to default, because Lula was being elected for the first time. And I remember my boss basically saying one day, last chance to sell Brazil. And then, of course, well, Lula came in, he didn't default, and everything rallied. And that was really the kickstart of the love fest for emerging markets over the next 10 years. And nothing could go wrong. It didn't matter how much of a basket case you were. It didn't matter how much you looked into the fundamentals of these things. The credit cycle, which of course got pretty crazy later on, and the emerging markets. First for emerging markets meant that the capital was just chasing this kind of stuff. So it kind of taught me 2 things. One of which was that you can spend your time looking at the fundamentals, and of course that was interesting. But if the overall market is pushing in one direction and the flows are favoring you, then these things don't matter. The money just goes in. We got to 2007, 2008. Things as rubbish as Ukraine and Venezuela were trading at 100, 150 over treasuries, or over swaps, I should probably say. And simply this was just flow based. And of course it was all the the funky credit stuff that was happening at the same time as well. All this stuff was being packaged up. and this was just total garbage that people were buying. And it was a really interesting time, but it really, I would say, more than anything, it really didn't teach me very much about emerging markets and how they were. I wish I'd been there 5-10 years before, when everything fell apart in the 90s, because that was really, that was a lot more about what fundamentals mattered and what it was all about.
Yeah, okay, as opposed to just flows pushing us one way and structured
Yeah,
products.
that's right. And you saw it after the financial crisis. Emerging markets got ripped apart in September, October 2008. But then, China came in, massive stimulus, of course, stimulus everywhere, and it bounced right back. And, it was almost as if, at the end of 2009, it was almost as if what happened in 2008 just hadn't happened at all. I mean, clearly there were some small guys who were completely screwed by what happened in 2008, and most of those were the ones in Europe. But generally, for the big commodity exporters, the names that you think about when you talk about emerging markets like Brazil or, Russia, South Africa, it didn't matter. It didn't matter at all. It was like a blip.
Yeah, okay. So in hindsight, did you find um, working on a bond, obviously you sort of found it quite interesting, but in hindsight, is that kind of a more interesting space than, say, if you had been on an equities desk or something like that? Do you think? Or
it's interesting. I mean, I'd like to say yes, it is more. I mean, emerging markets are, they're very varied. But when it comes down to it, the main drivers of the dollar debt were what's happening to treasuries, and that was always been very important because, for reasons, the average duration of the emerging market index was pretty high. So if treasury was doing well, EM would do well as well, because a lot of EM is investment grade, a lot of it is 10-year, 30-year debt. So that's a big driver. And the second one is just credit spreads in general, and this is probably something you could almost say about any, form of investment grade credit or largely investment grade credit. If spreads are tightening, then credit does well. And it doesn't really matter what you're invested in. And this is probably the same for, US IG or European IG. And even in, for most of the time, that same goes for high yield as well, for the junk stuff. I mean, there's the stuff really at the bottom of the spectrum, which does its own thing. That's the Argentinas of the world. But even some of the like double Bs, even single Bs, most of the time, when markets are okay, this stuff is just trading in line with everything else. So EM equities, I think there's a lot more room for diversification. I think there's a lot more. I mean, I'm talking about this from a pretty low level in terms of knowledge, but I would imagine there's a lot more idiosyncratic stuff going on. So you've got to get the company right. It's not just about the country. You've got to get the company right as well. Although, of course, things are if the country gets pretty stressed, then everything's going to be going down to hell in a handbasket altogether. And then when it comes back, it's all going to come back altogether as well. So a bit less of that.
Okay.
Yeah.
And then, okay, so you're on the EM desk, and then where to from there? Did you sort of finish your institutional career there, or do you move on, or?
Well, a guy that I worked with very closely on the EM desk, who was always arguing with the woman who'd hired me, he said that I should get out and go and get some experience outside the place that I was in. And his background was on the sell side. He was an economist, an emerging markets economist, and he said you should go to the sell side. That's where you're going to learn everything you need to know. So I left, and I got a job as a research guy on the sell side, working in emerging markets, and it's a totally different job, but it's also great. I mean, I found working for the sell side to be it was invigorating. Every day you get in, you're working long days. If you work in research, you've got to hang around at the end of the day to make sure everything's done and written up and whatever else. But I'd be getting up, 5 o'clock every day to get into work for 7 or before 7, morning meetings. And then there's the day you'd be talking to clients, you'd be talking to people on the trading floor, and then you'd be writing stuff as well. And it's just like a daily cycle. It'd be like you get to the weekend, it'd be like, you know, I've got a 2-day holiday now. Whereas the buy side, and this of course won't be the instant case for, I'm sure, for a lot of people, but it's pretty sleepy. You know, you go in, one day is pretty similar to another day, whereas on the sell side, every day was different. You know, there was some structure, but effectively you were doing your own thing with the name of your bank. And as long as you didn't do anything particularly stupid or say anything particularly stupid, then you could just do whatever you wanted to do. And
Yeah, cool.
you know, I like talking to clients, they like talking to me. It worked out pretty well.
Yeah, cool. So how long were you on sell side?
Um, best part of probably 7 years, 8 years, something like that.
Okay.
So that was through the financial crisis, which was fun. I mean, at the time, it was all kind of a bit of a haze, and you didn't realize quite how existential it was. But I saw some stuff going down that was pretty fascinating. And then in some time after that, basically, I was hired by Emerging Markets Trading instead, to develop some products and also do some market making. And that's where I discovered that I was pretty terrible at market making. I just didn't have the mind for it. And I think a lot of this comes down to, it really is mindset. It's interesting. I watched one of your interviews, and basically the guy said that it's a completely different mindset doing market making. You are the greengrocer on a stall or something like that. Basically, it's all about inventory. It's all about managing your risk. Whatever your view is, it doesn't really matter. You know, the fair value for the market is where the market is right now. And, you know, where you think the market should be is completely irrelevant for most of your decisions on a daily basis. And I just found it impossible to separate those two things. So
Yeah, okay.
effectively, market making was not for me. I mean, it was a great experience. Love working with the team, talking to the brokers, getting, you know, the information on the market. I loved, you know, showing markets and making markets, but in the end, I just couldn't handle the risk management side of it. It just wasn't something that I could do.
Yeah, cool.
So yeah, and the developing product stuff, I mean, I mean, it wasn't a complete disaster going into trading, but the whole developing product side, I mean, some of that stuff worked and some of it didn't. You know, you have some ideas and you package it up and people do it and it works out really well. But then there was one thing, especially I tried to do related to inflation trading, which is something which can happen in some emerging markets and not others. And effectively, you just I got myself into a position where I had risks that I just actually couldn't hedge. And of course, when you're trying to develop something new, you know, there's no, you can't just call someone up and get, you know, unload some risk onto somebody else. You're basically on your own. And yeah, that was a learning experience. And yeah, I tend to stay away from things that I either don't understand or can't hedge. I think if I did it now, I'd do it very differently. But then I was just way out of my depth.
Yeah, okay.
It's
Yeah,
great. I mean,
enough.
it's great. And some things worked and that was fab. But some things just didn't work. And yeah, you got to move on.
Yeah, yeah, but you got to go through the process, I guess, to figure that out. Otherwise, you know,
Yeah.
sometimes,
Yeah. And I've got to say, you know, they gave me the chance. They gave me plenty of time to work it out. Unfortunately, it was a time after the financial crisis where balance sheet has been constrained. I think it probably would have been different in the years up to the financial market, up to the financial crisis, simply because the cost of hedging certain exposures would have been a lot lower. But yeah, didn't work out. And
yeah,
yeah,
fair enough.
you got to basically pull yourself together and move on into something else.
Yeah, cool. So what was that something else from there?
So yeah, well, I moved back to the buy side. I basically went and worked for a more boutique but emerging markets focused company. And this was at the height of the emerging markets boom. So this was 2011, 2012. kind of time.
Okay.
I mean, people were you were being given money faster than you could actually invest it. It was ridiculous. Basically, everybody wanted a
Okay.
piece of emerging markets.
Sounds
It
awesome.
was it was, and it also wasn't, because of course, if all the clients are piling in at the highs, and then basically all the client meetings, and of course, as much as the sell side is client meetings, buy side is also client meetings. It's all about the clients. You give them the bad news. Basically the stuff that they bought has gone down, and you try to paint a rosy picture. You say, well, this happens, blah blah blah. We still believe in the asset class. We still believe in the fundamentals, but year after year, from 2011 onwards, I mean, basically emerging markets peaked in the first half of 2011.
Okay.
And that was the big, the end of the big China stimulus. And then everything started, basically the bottom started to fall out. China started to have its first problems. Clearly the US went through this repeated cycle of trying to recover and then kind of failing and not achieving escape velocity, as I think Bernanke's favorite phrase. And the emerging markets it's all about growth. Basically, if there's no growth, then they're going to struggle. And I mean, that's continued to this day, to be fair, because the dollar and the US has been the focus. But yeah, it all just started to grind to a halt, and you saw the whole commodity super cycle thing just kind of ended. And the big emerging markets are all about commodities. Regardless of where you look, Latin America is basically all commodity exporters. Russia, South Africa, most of the small African ones, if you can be interested in those, and then Indonesia being probably the biggest and most interesting Asian market as well. It's all commodities. There are very few which do well when commodities are low. Turkey's kind of one. But even then, Turkey is still pretty highly leveraged on the whole kind of growth idea and stuff like that. So, yeah, I mean, these guys were piling in 2011, 2012. And then you've seen the charts. I mean, you can look at charts of EM equities because it kind of tends to be more exaggerated because China's much bigger thing in there. But you look at charts of EM fixed income, you just need to pull up some sort of random ETF. It's not a good story. Yeah. So by then I was working in emerging market local currencies, which is a much bigger, much more liquid asset class than in dollars. Clearly, you're taking a lot more risk as an investor. But of course, that was doubly hurt by this because not only was the EM growth story not there and that not supporting currencies, but of course the US was also, we've had a strong dollar cycle. EM currencies have generally depreciated against the dollar. And yields haven't really compensated for that. So clients have, at best, not really done anything at all. If they just stayed in treasuries, they would have done better, I would say.
Yeah. Okay. Yeah. All right.
So it's I mean, again, I can't knock it too much. I mean, I love talking to clients. I love telling the story. I love coming up with ideas. I loved, probably my USP is my attention to detail when it comes to portfolio stuff and just basically getting everything in line, keeping everything in line with the risk that you want. You'd be surprised at the number of people who just can't be bothered to do that on who really should. I mean, that's effectively your job. You're managing risk as a fund manager. But the asset class kind of soured. I mean, you got some great stories. You go to places and meet people and all that. In these emerging markets, whether they tell you anything that's actually useful or whether they tell you anything that's actually true is another matter. But you still get to see how things are on the ground. So it's been that was a great experience. But it's things changed. So a few years ago, basically, I was having some personal issues, and as ever with these things, Christmas Day, I can't remember what year it was. My wife basically just said it's either us or your job, because basically I've just been living in denial of things that were going on, and just throwing myself more and more into my job. And
Yeah, right.
of course, the job does that. You can spend as much time as you want. You're talking to clients, you're kind of managing portfolios. You can do 24 hours a day if you really wanted to. And the family was suffering. And when you're confronted with something like that, it's like, well, I've got to take my foot off the. I've got to prioritize family. So I just jacked
Yeah,
it. I just walked away. And it's biggest decision of my life. In some ways, there wasn't a great deal of downside. My wife had a good job and she was looking after the kids. So basically, we just switched roles. I just stayed at home, looked after the kids, and she went to work. And that's how it's been ever since.
yeah, cool. Yeah, good on you for making that decision, like kind of a big decision to make, but prioritize family, which is good. And so you're just taking care of the kids and trading your own money now. Is that kind of where you're at?
Pretty much, yeah. I mean, it took me a while
Yeah,
to
cool.
get into it. The whole trading thing. I really thought that. Well, it's difficult to take that step, I suppose. And so I tried a few bits and pieces, and of course, I always only tried emerging markets to begin with. Problem with EM is that it's difficult to find the vehicles in which to go long at the best of times, and it's pretty much impossible to find any vehicles in which to go short. Um,
Yeah.
so in the end, you kind of gravitate to other more liquid stuff. There's effectively EM is my first love, and if there's great opportunities, then I'll do something in it. But on a day-to-day basis, the correlations are so high with most of the developed stuff anyway that there's actually no point doing emerging markets on a day-to-day basis. It's
Yeah.
it's interesting, and I've got all my spreadsheets where I kind of keep all my information and stuff, and I follow a lot of what the goings on are there, but it's a lot of it is academic.
Yeah, fair enough. Okay, so what markets are you kind of trading now? You're just trading like US and European markets, or?
um I mean, I had to lose a bit of money to begin with to kind of push me in a direction of trying to find some sort of edge. Um, you
Yep.
kind of think, oh, well, this is going to be easy. I just need to, lean into this. I'm a contrarian. So I like to grab falling knives. The thing is I needed to build a framework where I knew which knives to grab and which ones to avoid. Um,
Yep.
and that's what has taken the time. So basically, I look at effectively at options markets. I look at the pricing of the option structure, and therefore you need to look at liquid stuff. So basically, it's where I can get prices. I can get full runs of strikes in various markets. So basically, it's G10FX or G7FX or whatever we want to call it. It's not many G's anymore, I don't think. It's
Yep.
stocks, basically mostly developed markets or only developed markets, and some commodities. And some of it leads
Okay.
into EM. So, take your own currency, the Aussie. I mean, I would say that's probably the most EM thing that I look at. I mean, it's certainly, being a commodity exporter, you certainly have a lot of the characteristics of that. So I can use that as a bit of a
Yep.
a hunch as to where the cash is going. If Aussie is doing well, then it's likely the rand is going to be doing well, the Brazilian real, blah blah blah. But most of all, I've just had to change my focus and
Yeah. Okay.
learn about how these things trade.
And then so with the trading that you're doing at the moment, like what's your kind of thought process around, a new trade or a new investment? Is it purely sort of model driven, or is it discretionary?
Um, I
A
two
bit of
things at two
both.
different
Like, how are
levels.
you, I guess, making?
Yeah. It's at two different levels. In terms of the real money side, so just, money rather than leverage, it comes down to a question of basically bonds versus stocks. And I mean, I know that's boring, and it's kind of a very kind of real money way of looking at it. And of course, in the real money way of looking at it in the old world is that stocks were what you were invested in 90% of the time, and then bonds were just there to be the cash substitute and were there to do nothing, or act as a bit of diversification. But I do try and flip between the two. And my main view is, is my Twitter tagline. It's about growth. If growth is looking up, then you want to be in stocks, and if growth is looking down, then you want to be in bonds. And that's a very broad brush, high level thing, and that's basically how I manage the real money side, in a way.
Mm-hmm.
So at the moment, I'm basically in cash. I've been in cash for quite a long time, actually. I just can't, US growth has been decelerating for, a couple of years. Well, actually, it hasn't really. Global growth has been decelerating for 2 or 3 years now. US growth has kind of been holding up, which has been reasonably frustrating. But I don't really want to change that. I want to see the growth cycle turn up if I'm going to go back into stocks.
Okay.
In terms of model-driven stuff, I basically look at things such as the skew, the put call skew in on option structures. I look at the level of vol, and I have a smaller thing which I do on using leverage stuff, using options. It's just selling options when I want to lean into something one way or the other way. I have a bunch of thresholds. I've got a load of historical data that I've been collecting, and I basically just look at the thresholds where I want to lean one way or the other.
Okay.
Works pretty well in FX. It works reasonably well in commodities, although clearly, commodities can go a bit wild at times. And of course, if you're selling options, then you need to watch out for that. Doesn't work at all in stocks, and I've never worked out why. It just doesn't. And I'm guessing it's because there is a whole industry of people who do things with the vol structure and stocks, and that therefore has some way of altering the structure in a way that I just don't understand, or the way it behaves differently to other markets. But it's just, I've had some costly encounters with stocks over time in terms of trying to fade things one way or the other. And no, I just don't do that. I just, I can have a view, but and I might take a punt here or there, but in general, it just doesn't seem to work.
Yeah, fair enough. Yeah. And then, so while I've got you, and it's kind of timely, US CPI is going to be announced, a couple of hours after this is being recorded. And, there's a lot of kind of debate in the world at the moment around the US and soft landing or not, and how many rate cuts we'll get this year, and will we get any, that sort of thing. Where just your sort of comment earlier about, global growth and US growth holding up, where do you kind of sit in which camp around where the global economy is heading, where the US is heading, rate cuts, all that sort of stuff?
Well, I mean, the first thing to say is that me, like a lot of people, spent the last 12 months at least being pretty wrong about the US. I basically thought that, Fed would hike a few times and the whole economy would just collapse like a house of cards, or one of those collapsible stools or something like that. And that's just not happened. And I mean, there's some compelling reasons why. Fiscal, for instance, has been very favorable in the US. And you can compare the US to other countries around the world where, you've had basically a lot of places have been in recession over the course of the past 12 months. But it just hasn't mattered. The US is whenever you have a view on global macro, the US is the elephant I'm mixing my metaphors here, but the US is the elephant in the room. And if the US isn't going to go well or go badly, then that's basically going to take the steam out of everything else in either direction. So effectively, the US has held up very well, and that's meant that everything else hasn't collapsed into something awful. But also everything else hasn't managed to drag the US down. And you can see this, I mean, China's struggling massively because of what's happened. I mean, I think China's probably, into a decade-long hangover from the property boom. But even that hasn't really mattered, to be honest. I mean, China is a bit more separated from everything else because of the capital controls. But, it is also a big animal and it should make a difference, but it just doesn't seem to be doing that at the moment. So, so this year, I mean, I think we're still into the whole long and variable lags thing, but, and of course, the one thing we've got to say is that, that works both ways. So after hiking, there's a lag, but also after cutting, there's a lag as well. So the Fed will cut this year. I'm pretty certain they will. It's pretty clear that inflationary pressures have diminished very significantly. I think it's not clear whether the US is going to go straight into something much lower inflation than we've had for the past couple of years. I mean, clearly, the previous decade we had no inflation at all. So, I mean, but of course, people's views on that have changed. So I don't know how much they will, but the speed is going to be governed by whether they feel they have to. And at the moment, of course, the economy is fine. So I would say that to a degree, they're cutting because they can or because it would be nice to rather than because they have to, which means that there's no need for speed.
Yep.
So in order for them to, we've gone into this year with a lot of cuts priced. I think for that to be realized, something bad needs to happen to force the Fed to do something rather quicker, or the data's got to roll over or something like that, or both. So if that happens, of course, then rates are going to go down 200, 300 basis points. We're probably going to get a massive bounce in risk after that. But I'd be, reasonably cautious right now. Either interest rates are going to go up in the market, the Fed interest rates aren't going to go up. And that's going to have an impact on everything, or something bad has to happen, which is going to drive interest rates and force the Fed to cut rates significantly. I just don't see there being much of a middle way. I remember in another one of your talks, you were talking about, you want to reset and everything to basically just reset to how it was before COVID and before all of the craziness the last few years. I don't think that's going to happen, or at least that's not going to happen without something tremendously awful happening. So, crazy things are going to keep happening. On the good side and on the bad side until the music stops. So I think the Fed probably will cut. I mean, you get drawdowns in markets every so often. So I just think that if that's nicely timed with inflation being low as it is, and of course growth still moderating as it is, then that's going to basically lead the Fed to doing more. And then we could get a nice kind of reflationary uptick after that. I think that's probably the best way of doing it. I think this year is possibly down and then up, maybe up a lot. The unknown, and I haven't seen anyone opine on this at all. Of course, normally people are all over this, is what on earth happens with the US election at the end of this year? Because the thing that's held growth together has been fiscal policy. And, Biden has not really, there's been no moves from the Democratic administration to tighten things up in any way at all from a fiscal perspective. What happens after November, especially in 2025, I've got no idea at all. And I haven't seen anyone have any opinions about this whatsoever. But it's pretty clear that the US can't go on running, 5-10% of GDP fiscal deficits forever without having some sort of impact on something. And if they stop doing that, then that's going to have a pretty horrendous impact on growth. So, I'm trying to keep things before the election because I have no idea what's going to happen after the election. Absolutely nothing at all. No idea.
Yeah, I feel like the election's like this big unknown that everyone's kind of ignoring, because half the world's kind of terrified that Trump will get back in, and the other half of the world sort of wants him back in, and you know, it's just US politics is just a disaster. So everyone's kind of ignoring it until it's like right in front of us.
Yeah, no, that's true. And I think that the big test, I mean, if we talk about the Magnificent Seven, is anyone going to go after them? There'll be, I can imagine it's a pretty easy political move to make. Just say, start talking about these big tech guys, they're making all the money. Clearly at the moment, everything's kind of good, doesn't really matter. But all it takes is things to be slightly less good. And you can start to see the, people running after the Silicon Valley guys and saying, hey, we want a bit of this, or you guys are a monopoly, we're going to break you up. I that's where the politics has an impact. No politician wants to vote for tighter fiscal policy and making people unhappy and a recession or whatever else. But, they would vote for breaking up big companies and saying the American taxpayer should be getting something out of this or whatever else.
Yeah, fair comment. All right, so we kind of talked a lot about your past and what you're sort of doing these days and that sort of thing. And one comment you made just around China, and obviously that's a bit of a basket case this year, and well, not just this year, probably last couple of years. And a comment that they're on a sort of a 10-year workout. Is that sort of your view, that China's just going to be this elephant in the room for the next decade?
Yeah, I think so. I mean, you look at the investments to GDP numbers that we had a decade ago, and it's really high. Basically they were throwing money at all sorts of projects, all sorts of stuff. You have that ridiculous statistic where China used more concrete in 2011 than the US used for the entire 20th century. There's just been a whole festival of bad investments in China, and this stuff just doesn't work out quickly. Whether this is a Japan style 20, 30 years of stasis, or whether it's a European style blow up, because of course we had something similar happen in the some of the more peripheral Eurozone economies in the run up to the credit crisis. I don't know. I mean, I think Europe is still working through a lot of this stuff. I think that's the reason why Europe kind of sucks from many investment perspectives at the moment, and it may well continue for another decade in Europe. I don't know. But these things take a long time to work out. Even in the best circumstances, even in places where you have, there's no social fragmentation or anything like that. Japan has, you had the peak in 1990, and we're kind of getting back to that now. I mean, that's like, the best part of most of our lives. These things can take a very long time. So we can't expect anything from China. That's a problem for emerging markets because, of course, commodity exporters, blah, blah, blah. For developed markets, I mean, I think it enters more the political dimension. How does China's going to have to change itself to respond to this kind of stuff? And how's that going to work? Is it going to lead to more of these issues with globalization that we've been seeing and whatever else? China starts to take itself away maybe from this stuff. I don't know. These are geopolitical ramifications that are beyond anything that I would ever work out. But they're big enough to look after themselves, but they don't at the moment. They're not big enough to sort out the problem that they have at home, and they may not be for a long time.
Mm-hmm. I'm kind of a similar view. I mean, not that I'm a China expert or anything, but it's obviously been, Australia's benefited quite a bit over the last, decade or so with everything that's been going on in China and all of the investment and that sort of thing. And it seems to be unwinding. And as you say, you can't sort of solve these issues quickly. So you probably, and they're at a point where they can't just reinflate and start all over again. So
no, they can't. They can't.
Yeah.
But Australia is somewhere where I'd be pretty negative about. But Australia is there's a whole bunch of countries that have, floated on the back of China, pretty much all of Latin America, with all the hard commodity exports, ditto South Africa, a lot of the African countries as well. You've got to work out, if China pulls back from an awful lot of this stuff, it's not going to have an impact on China. It's going to have an impact on these countries. So, yeah, it's kind of hard to construct anything particularly positive from that perspective. And therefore, when you're looking for things to turn, this has been the cycle of the US. The US has dominated everything for the last 15 years. The dollar has appreciated and it will continue to do so until this cycle ends. Big tech is the same. You read all this stuff about how, it's the time for the Russell. No, it's not. It really isn't. This is just, this is just hope. This is just active managers hoping for some, people all piling into energy because energy ETFs are cheap relative to tech. That's not going to end until the cycle ends, and the US outperformance is not going to end until the cycle ends. But then you think, well, next cycle, where do I want to be? Europe still going to be working through all this rubbish from the Eurozone crisis? Maybe. I think everyone would say, hey, Japan. But the problem, of course, with Japan is that its neighborhood is China, and there's a lot of economic linkages there, which aren't going to be particularly helpful. So I'm kind of scratching my head. It's not going to be the US. All these metrics about how the US equity market is 3 standard or 4 standard deviations of where it should be from fair value from all the other equity markets are true. And on a timescale of a decade, being short the US and long everything else is going to be a good thing to do. But it's not going to end today or tomorrow. It's looking for the next big thing is kind of tough at the moment. But then again, I suppose it always is. So, that's what we're paid the big bucks for, I suppose.
Yeah, that's right. And, it'll just pop up out of left field, like it won't be something that we're planning for. It'll just be some obscure thing that all of a sudden there's enough of a change and enough money moves around that all of a sudden the party stops and we're back to the drawing board. Yeah. All right. So let's lighten the mood a little bit. We've both been getting a bit pessimistic on the on the outlook there. Maybe just one of the things that's helpful, just like, I guess, you like your best investment, your worst investment, and what you learned from them over the years, whether that's since you've been trading your own money or whether that's stuff that you saw in your institutional days, whatever you want to riff about.
Yeah. So many bad things to choose from. They all get imprinted on your heart, in your brain. It's, for me, the biggest problem I had, as I said, with the market making thing is just detaching my view from what I should do, in terms of I've got to take my heart out of what the brain is deciding to do. Or put it another way, in my head I will have a view of what things are going to happen, and I will try and construct a view around that, and then basically, for whatever reason, that will be the wrong view, might ultimately be the right view, but for the time to be the wrong view. So, for example, 2019, basically, global economy was nicely rolling over. Basically, we got the peak of the cycle was probably middle of 2018. You short stocks, and of course, everything falls apart at the end of 2018. And then the Fed cut rates, and I went into 2019 short stocks, and that was just the wrong thing to do. It's growth didn't improve because the Fed cut rates, but of course the Fed just cut, and that was enough in the ZERP environment that we had to make everything, to buoy everything up again. And that was a pretty costly thing for me. I managed to rally round and have the same view again going into 2020, which proved to be incredibly lucrative, and that's probably worst trade to
Yep.
best trade in the space of 12 months. Basically, I underestimated the impact of the Fed cuts at the beginning of 2019, and then I got COVID right. And that's probably my greatest strength, is that when I see something changing or something going wrong, I recognize that for what it is. And it may be that because I've got my models and I kind of see things that are happening that aren't really in line with what should be happening, but you can see something change. And COVID was something that, you know, something had to happen. The cycle was still coming to an end. Of course, I didn't expect there to be a global pandemic, but when that began, it was like, well, okay, everything, you know, we're going to hell in a handbasket here. And that's exactly what it proved to be. But that time, in 2020, having learned from my experience in 2019, when the Fed came along and did what they did, when, you know, the US administration came along and did what it did, then I made sure I was on the right side of the trade. So actually, the most pleasing thing for me was what happened when the market was going up 2020 going into 2021 was just like, you know, I'm a contrarian guy. What happened with COVID was great. Don't get me wrong. But frankly, that's what I should do. Whereas what happened in 2020 going to 2021 was, you know, I'm terrible at taking profits early. And I didn't that time, and that worked out really well for me. I was very pleased about just getting the risk on. I'm not someone who likes to be long risk when everyone else is going gangbusters.
Yeah, okay. Yeah, but good that you kind of recognize that. You go. I was just going to say it's good that you kind of recognized the change from 19 to 20 and obviously COVID, and you're sort of short into COVID. And then as soon as the, you know, cuts come, you sort of learnt from your prior errors, which is a good thing. We've all got the errors as long as you learn from them. I guess there's some purpose to them.
Yeah. Yeah. I mean, that's the thing. So it's just, but the other main thing for 2019 was just learning that when the situation changes, you've got to change as well. You know, regardless of what your backdrop view is, it's the end of the cycle, growth is slowing down, blah, blah, blah. That can be right, but it doesn't have to be right for a certain 3-month or 6-month period or something like that. You've got to just get it. You just got to change or hold back. Just wait for something. You know, the other thing I've learned over the years is that there's always time. There's always time to put on a view. If something's going to happen or something's going to change and something's going to go wrong, you know, you're not going to wake up on Monday morning and the entire world has collapsed. I mean, that might happen in some random emerging market where, you know, the central bank closes the banking sector or something like that. But at a global level, that's not going to happen. There's always going to be view. And the problem with that is that you look back through time and people show pictures of 2008 or 1987 or blah, 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 blah. And it all looks very quick. You know, you look at the chart goes straight down after years of like going up very, very slowly up the staircase. You know, the falling down the elevator takes no time at all. But when you're actually there and when you're actually doing it, it does take a long time. Okay, 1987, it didn't. But, you know, 2008 took a year or more than a year to kind of work out. And yeah, there were some pretty hairy times, but, you know, the money was made not in those massively hairy times. It was made at the other times. And so that's it. You don't need to be prepared. You don't need to have your stock of put options hedging you against all sorts of events and something like that. When something comes along and causes a massive problem, it's going to be really obvious when it does. And it's just the very fact that people get caught out is a measure of the hubris and complacency that's out there, rather than the fact that these things aren't obvious, because they are obvious when they come out, and you do have time to respond. So you don't need to be ready with your portfolio hedge immediately. It's
okay. Yeah, that's a good comment, actually. Yeah, sometimes I wake up at night and think, you know, I sort of sometimes I wake up at night and think, geez, I got a lot of risk on here, and you know, what if the wheels all fall off on Monday or you know tomorrow or whatever. But when you say that, you're right. Like even COVID, like although that was pretty quick, um, it was also quite slow. Like there was quite a bit of build up to it, and there was plenty of time to sort of become aware that this was becoming an issue and make adjustments and that sort of thing.
That's right. It's just the problem is it's a matter of distinguishing between what is just people screaming about headlines that aren't actually very important and what is actually something that's going to change the world and make a big difference. And I guess that's the skill. But yeah, it's I mean, as I said, I spend a lot of time looking at options. You know, at times when volatility is high, that's great. You know, you can sell options all day long, you make lots of money. Generally, when you buy options, you lose money. And it gets to times like this, you know, the one that we're currently in, and probably quite a lot of time over the course of the past 2 or 3 years, vol is low and has come down a lot. You know, vol is very, very low in stocks, and it's also low in currencies. It's a bit higher in fixed income, but it's not off the charts. You know, my main way of doing that is, you know, you've got to express you can't sell vol anymore, right? Well, I mean, people do, of course, but I can't because that's just the way that I'm made. So you've got to start thinking about, where do I buy vol? Where do I put on, you know, long options positions? And the problem is most of the time you just lose money. So, you know, I've come out of a year, 2023, where I've just spent money on options and those options haven't paid out. It's kind of very frustrating. But I know that if I just, you know, keep doing that, then at some point something's going to work. And secondly, opportunities do come along where you can sell vol. Things will blow up very quickly in a short space of time, and you can just fade that. It's there's always time. There's always another trade. If you miss the trade, don't try and jump onto it late, thinking this is the only chance I'm ever going to make money ever again, because that something else will always come up. You know, there's always going to be something in somewhere. So you don't need to chase stuff. And secondly, at times where you're just sitting around doing nothing, trying a bit of this, trying a bit of that, and nothing's working, you know, at some point that will change as well. You know, don't get frustrated. Don't start trading much bigger, hopefully to pick something up. Don't change what you do, because that's not going to work. I mean, I've tried that and that definitely doesn't work. So yeah, you just gotta wait. And the hardest thing with markets is waiting. While everyone else is cheering and saying, oh yeah, you know, I made loads of money and this and that and the other, you just got to sit back, and the hardest thing to do is to do nothing.
Yeah, it's hard. It's a waiting man's game, but we're all kind of impatient, where I am anyway.
Yeah. No, we all are. We sit there every day and look at the screens. The best thing to do is just turn off the screens and go outside and do something else, or learn to play the piano or whatever.
Yeah, that's no fun though. So all right, so just I guess any advice that you'd give to anyone who's just sort of getting into markets, trying to figure out what's going on and, you know, find their sort of place in the world. What would you sort of, what's the best place for people to start to get their head around what this is all about?
I mean, you've got to. I mean, this is a much misused phrase, or not misused phrase, but it's a trope that's just used all the time. You've got to find your edge. I mean, I have a good idea what my edge is. There are times where I veer off the beaten track, and I always just have to get back onto it because I've got bored and I want to do something else, and it just never seems to work. You've got to be consistent. You know, you've got to realize what you're good at and what you can do, and just do that, and try to avoid all the temptations of this and that and the other. And, oh, well, you know, I wouldn't normally do this at this time, but I've got no positions on right now because I don't see anything. So maybe I'll just try this because somebody else is doing it. That, you know, don't do that. Don't get distracted. But the second thing is, and this is probably goes further into into, you know, more general portfolio management. People should spend more time looking after their investments. I mean, I find it absurd that we're all effectively saving for our retirement or whatever else. I mean, if that's ever going to come, I've got no idea, given, what's happening to savings and retirement rates and whatever else. But, people just put money away and don't even think about it. And there's somebody somewhere who's taking, some basis points every single year from that for managing it or not managing it or whatever, just sitting on it. And, some of these things you've got to pay. You've got to pay for custody and whatever else. But a lot of this stuff, these tracker funds, not even tracker funds, but, actively managed funds, they're just taking money out of people's accounts and people just don't think about it because, it's for the retirement, it's for a long time in the future. Whereas if you took over the management of it yourself, you'd save a bit of money, might learn a bit, and, you're not going to be paying the man money year in, year out. Your money might go up or down, but their money only ever goes up because they're just taking a fixed proportion of your savings. So, it's not just about the kind of leverage stuff, the day-to-day stuff that we look at. It's also about these pots of money that we have, and you should be looking after those as well. So, if you just got to stick it in some index fund, fine, but it's better that you stick it in an index fund and pay the small fee for the index fund, then you pay somebody else to stick it in an index fund for you, because then you're losing money in the index fund and you're losing money just delegating that process to somebody else who probably doesn't have as much clue as you. And certainly because it's not their money, they care about it a lot less than you do.
Yeah, fair point.
That's my gripe. I mean, I find, the best jobs in financial markets are the ones where you're paid to manage somebody else's money, because, it doesn't matter how good or bad you do, you still get paid. It's, I've done the whole managing other people's money thing. It's great. I'm good at presenting myself. I'm good at doing the chat, but would I make you money? Well, maybe a small degree away from 50%, but you might be better at doing it yourself.
Yeah, fair point. Is there any sort of final thoughts that you wanted to share, or anything that we haven't covered that you wanted to kind of talk about?
I've been quite negative. I always struggle to be positive. It's because I started off in fixed income in government bonds, and you join an asset class where everybody believes government bonds are expensive. I mean, this is why we've had a 40-year bull market in government bonds, is because everybody believed yields would go up because, this was ridiculous and new and whatever else. So I've always grown up with the idea that the asset class is any asset class is overpriced. And I have to fight against my bearish instincts with that. But my main concern from a market perspective is not, markets. There'll always be opportunities. Things will go up, things will go down, blah, blah, blah. Is your broker. And, this is the thing. I mean, these are, clearly we had one of the biggest brokerages go bust in 2008, but I'm talking about retail. We are very reliant on these people who have our money. And now, of course, it doesn't have to be an FTX type scenario where someone runs off with your money or gives it away in political donations. Effectively, a broker has a portfolio of credit. They're lending money to thousands of retail investors, and we know that a lot of these bets are correlated. And the thing that keeps me up at night more than anything else is that, my bearish bets won't pay out because my broker will go bust. And that's the thing that really, that's the thing that really screws me up more than anything else. Markets go up, markets go down, countries go up, countries go down. But being unable to access your funds, or your broker, basically, because you're effectively lending them money by putting their stuff on margin with them, and they're lending it back to you against your margin. It all gets kind of very circular. That's the thing that you have to watch out for. Now, clearly, you don't need to go as far as me. I keep my margin levels very low. I basically get margined all the time and have to put more money in when things go badly, because I try to keep things very tight. I don't want to have much exposure to a broker, and that's a pain in the neck. But yeah, people should
fair enough.
be aware of that. That is a non-market risk that we're all taking that we don't necessarily think about.
Yeah, that's a good point. Yeah, and it's not something that people think about day to day. More so in crypto, but certainly less so in sort of traditional finance. Yeah.
Yeah, that's
I
right.
don't
I
know
mean,
how the
these
crypto.
are these are tail risks, very, very, very small tail risks. But that will be a bummer. And you've seen people lose out on FTX. Now, clearly, as I said, that's because of someone being a bad person. But it's there are ways that you can have to protect yourself in some way. So whether you can hedge against your broker by selling their stock, I mean, I think that's the case. You can do that with some, but then you have to do that with a different broker. So yeah, it's brokers all the way down.
Fair enough. Well, look,
Anyway,
mate,
I'll try to be more positive if we ever speak again.
coming. You haven't been that negative. I think I would describe you, which is the most important thing. So, but look, thanks very much for coming on the show. I've actually really enjoyed it. It's been really good to talk. Good.
It's been a
Thanks
pleasure.
everyone for listening and watching. I really appreciate your support. Yeah, thanks again, mate. And for everyone, we'll see you next time.
Cool.
Peace.
Thanks very much, Michael.